Tommy and let you introduce yourself and start the our chat.
Sure. Yeah, for sure. Let me just make sure the screen share comes up okay. Give y'all something to look at other than my horse teeth here. But nice to meet everybody. Jerry, that doing the roundtable of introductions was very helpful for me. So my name is Tommy Brandt. I'm based out of the Nashville area, a multifamily syndicator full-time since 2021. So I've been focused on that. My buy box is in Tennessee, Kentucky, Alabama, Georgia, and opportunistically considering other markets, considering those markets are red hot and sellers' expectations are not aligned with my buying expectations. So yeah, recovering electrical engineer. I'll talk a little bit more about my history there, but yeah, I'm excited to be here today. Last year we looked at nearly $1 billion in real estate, and this year has been a lot different. And so I'm happy to share some lessons learned along the way here, and what I see the market doing. I'm in probably 3 different masterminds in different capacities. So happy to share what other people are seeing. Other high performers. I'm hoping to add some value to y'all today. We've got a pretty intimate crowd here, so if people want to put questions in chat, or if you have a burning question, feel free to take yourself off mute. If you're thinking it, probably other people are thinking it as well. I don't have a lot of slides to share with y'all today, but I think they are jam packed. But the 2 questions I had were, where are y'all from, and then what's your experience level? And everyone's elevator pitch was excellent. Everybody covered that. Everybody passed. So thank y'all. I think we've some of the folks here have known me for a while, or we've run in the same circles for a while. But this content right here that I'm going to be sharing with y'all tonight is for apartment investors and operators. So if you want to be active, but also be passive in case you want to call BS on somebody that tries to bring you a skinny deal to throw some cash in, hopefully this can help give you an idea of what to look for. So bear with me just one second. So a little bit further into my introduction. So I am happily married. I'm blessed to say that I'm married to my best friend. We've been married. It'll be 3 years come September 10th. And we have 2 children. They have coats of fur, Jerry and Latte. A funny picture on the bottom left there, if you're looking at it. So my wife is Cambodian American, and we went to Cambodia for the first time with their family last year, and we dressed up in traditional garb and took some wannabe engagement photos there. It was a lot of fun. What you probably can't tell is it was raining, and so we are just soaked. And the friends were like, "Give me your umbrella." I was like, "But it's raining," and they didn't care. So monsoon season in September, by the way, makes no sense to me whenever it's their summer as well. I am a recovering electrical engineer. Thankfully, there are a lot of transferable skills to being, in support, sales, and operations, to now being full-time real estate investor and running your own business, being an entrepreneur. So I've got a humble portfolio. I feel like there's people more qualified than me in this room to talk about what we're going to talk about today. But I'm here nevertheless. So I've got a couple long-term rentals. I've got a short-term rental. I have JV'd storage. Invested actively on the LP side as well as on the GP side of apartment syndication. I've also got some chips and a self-storage fund, as well as a build-to-rent community in Middle Tennessee as well. And so last year, that was basically me giving into shiny thing syndrome, and this year me tightening up my buy box and really eliminating and identifying where I did and didn't feel comfortable taking risk, or just knowing like where the risk could be mitigated. Just kind of a funny slide here. I think whenever you tell somebody that you're a full-time real estate investor, different people have different conceptions of what that really means. I like to keep this stuff pretty lighthearted but informative. But as far as my friends think I'm just networking all the time. When people hear real estate investor, people think, oh, you fix and flip houses. No, not quite that simple. And then, what I think I do, I have to pull the emotions out of it and be able to buy off of numbers and buy on the spreadsheet. And then, what you really do, if you've ever, actively acquired or disposed of an asset, you are just hurting all the cats. So, with that said, let's jump into, I think it's a mandatory disclaimer. To sum up everything here, I'm not a financial advisor. I'm here sharing my opinion. I'm not sharing guidance. I'm not soliciting securities. Past performance is not indicative of future results, and I think that's about it. So, with that, these are the talking topics for today. I want to jump right into what are the headwinds of the industry, and then really two legs out of the three-legged stool of syndication are acquisitions and asset management. So, what are some things to be aware of, whether you're acquiring or whether you're actively managing, as it pertains to the industry? And I can't see chat, but Jerry, keep me honest on any questions that come in.
All right.
Cool. Awesome. So as far as headwinds to the industry, if you've been following it, it's probably no secret. It's physical vacancy. Physical vacancy has been on the rise. I think year-over-year vacancy in some markets are hundreds of basis points, Marcus and Millichap or CBRE, some of these reporting is companies that publish reports. They say that households are consolidating. I think that's a nice way of saying that kids are moving back into the basements. There's just taking on more roommates in a studio or 2-bedroom apartment. Not that there's anything wrong with that, but it's basically having an effect on the industry. What I want people to be mindful of is, because I'm also part data scientist, is that whenever we get these numbers, we're always tend to be looking at the average of everything. So that's the average across the entire nation. That's the average across A, B, and C classes. So it's hard to get a true measure of which asset class and which markets and submarkets are truly affected. That's why I think it pays to be an expert in wherever you're looking. Obviously, you look at California and you can see they're pissing off all their wealthy people. So it's no surprise that there's probably higher vacancy in some of those markets. Or if you have a really attractive market in the Southeast that has organic job growth, and it's beautiful, maybe you're in the Appalachia Trail, or they're in, right, you're going to have organic draw plus, job markets, jobs are bringing people as well. So things to think about, people follow jobs. That old adage is kind of falling apart as people are getting into more flexible work environments. Economic vacancy and collections kind of go hand in hand, right? There's some people that are falling on hard times. They're not seeking assistance, and they think that it's okay for them to just live there for free. They'll pay their cell phone bill before they pay their mortgage. So there's just kind of an interesting dynamic in priorities and where they sit with some folks and renters, and that's where the asset management side of things, it's so critical to make sure that you've got the right tenant base within your community that you're trying to build. Think about the job market in the tech industry has been very, very boom and bust. You look at the physical vacancy and economic vacancy in Phoenix, for example. It has a ton of tech exposure, and it's no surprise that vacancy is going up in those markets. Also, we're not going to talk about it a lot, but think about new construction, right? So if think about what has been built since 2015, no one has built a C-class property, right? The only thing that's made sense to build for nearly a decade has been A-class product. And so whenever we're talking about new product coming to market and absorption and new construction for the next 12 months, that's all going to be A class. A class basically represents your ceiling for B and C class products. So while your A class issues that they're having in primary metro areas aren't directly affecting the C class, it's important to be mindful of and try to break down some of these headwinds, class by class. The good thing about C class and B class is they are not making that anymore. It just doesn't make sense, financially to do that. So moving on to concessions, we've already started seeing some concessions, even in some of the lower tier products, and that was during December, November, January timeframe when it just like vacancy just seemed to hit a lot of different markets, a lot of different ways, all at the same time, and so people were really quick to do concessions. I guess the storage industry in Nashville has been doing concessions since middle of last year. So you really got to be mindful of absorption when it relates to your market. There's one story I like to share. I was at a broker event a couple of months back. There was like this, super high class penthouse in the best building in Nashville, and they were giving 3 months living at 3 months for free. They were waiving the application fee. They were giving out a $2,000 gift card just to get a body in that place. So it's pretty crazy what's happening. So definitely something to be mindful of if you are secret shopping, or looking to get into A-class product. I think they've got a lot of exposure right now. Rent growth, I've been hearing, a mixed bag on rent growth, that some markets are still showing year-over-year growth. Some people like to be cute and so, do month-over-month growth, which is just a dumb metric. But so be mindful of, where the benchmark is whenever you're getting some statistics like that. I think generally speaking, B and C class rent growth is still, it's normalized and back where it should be, falling in the 2 to 3% range year over year. I won't even say year over year, but from your previous pro forma to current, right? You're probably going to get $50 to $75, on every renewal that you get. That's going to be the norm. Rent growth is always going to be an average metric. And remember what I said before about the term average. So all of your A-class outliers are really skewing your rent growth and what's going on in the market. So get super hyper focused based on what your buy box is. So for me, I'm still seeing, healthy growth. But we'll talk a little bit about how this affects, underwriting and, how we're buying things differently. But you've got to be mindful of rent growth in your asset class. So I'm going to jump to underwriting here. If there's no burning questions, but how are these headwinds affecting how we're buying? I think it's just it's a fair question. So exit cap, I'm not sure how many people in here are extensively underwriting deals or analyzing deals. But when I was coming into this industry a couple of years back, there was the general consensus that if you underwrite for 10 basis points a year for cap rate expansion, that you would be fine, right? That was you being conservative and showing that, hey, that's the market working against me. Look how conservative we are in our underwriting. I think now if you want to be responsible, you're probably doubling that. And for some of the shorter term holds, right? Maybe that looks like 25 basis points a year for cap rate. So instead of trying to benchmark it from where we're at today or where we're at last year, compare it to where we are in a normal debt cycle, or at a normal debt point, because 10 basis points per year cap rate expansion on top of 0% interest rates, doesn't make a whole lot of sense. So our exit cap we've been aligning those with where we've been more the 2018, 2019 times where interest rates were kind of just starting to go back up. What was the market doing? What's the normal? The other thing too, because we're not building B and C product, we've actually seen the cap rate compression across classes. So you've seen the cap rate compression between B and C class products just get tighter and tighter and tighter, to where a C class product will trade at about the same cap rate as a B class product, which just doesn't make sense. But that seemed to be the narrative. If you were trying to buy in Middle Tennessee or East Tennessee couple years back, how we've pivoted in our underwriting for rent growth. We no longer underwrite for rent growth in year one. I know people that do not underwrite for rent growth in year two. It's all extenuating circumstances and every market is different. And this is not a blanket statement, but I think, quarters 3 and 4 this year are probably forecasted to be the worst quarters of the economy. The Fed has been very open that they've been surprised that the consumer has been so resilient, which I think is a nice way of saying that people continue to use their credit cards. And we have yet to see some of the fallout from that. So, I think it's still, frosty and not wise to just assume that you can get rent growth immediately. I could lump up a lot of things here as far as the insurance goes, but just expenses in general. Insurance, it's very market by market. Houston is not the same as, South Dakota, right? But just be mindful of that it's probably not going to go down, right? It's probably not going to get any cheaper. You're probably going to have to underwrite for a faster paced expense growth in insurance than other things like payroll or advertising or things like that. Things to be mindful of there. It also there's dynamics in the insurance industry, just because I have close friends that are brokers. So I think it's nationwide and travelers that are no longer writing new business. And that's more on the personal side, right? That's not so much in the commercial side, but, how much of that, how much time is left before that's the case, right? Before, we're not we're not taking on new relationships anymore. It's just going to, I think insurance brokers, commercial insurance brokers are going to be worth their weight in gold to help you find the right product, but in a way that doesn't expose you too much to risk. Property taxes. I think everyone that lives in that's invested in Texas this year that got reassessed is feeling the weight of property taxes. So as real estate appreciates, even if the tax rate, the mill rate stays the same, taxes are going to go up inherently. So you've got appreciating real estate, and some places are increasing their tax rate and their mill rate, and that's just going to kind of have a compound effect as far as the property taxes go. So and this is more universal, right? The property taxes from the owner is always, or from the person I'm trying to buy it from, the owner, their property taxes are always going to be cheaper than what I can get, right? Their P&L is always going to show lower taxes than what I should be underwriting for. So don't get caught in that. Same for insurance, right? The owner's insurance is going to be cheaper than anything I can get at market today. So just don't forget to underwrite for increased insurance and property taxes. I did have a couple notes on debt. Okay, I'm not missing anything. So, there's small bank loans, credit unions. These are probably great for more in the smaller size properties. So 20 to 40 units, something about that. The challenge is if you're trying to get, let's say I don't have any money, right? I'm trying to find a partner that will help me take down this deal. Well, they're basically signing on for recourse. So it gets to be a point where you have to have a team that's okay with recourse. If it's a screaming hot deal and a screaming hot market, maybe that's an easy sell. But, imagine that on the other end of the spectrum where you're trying to buy a 100-unit complex and you've got recourse debt because you don't want bridge loan and you don't qualify for agency. Then it becomes a real discussion. They probably want more the GP or more the ownership team. They think they're taking on more risk. They probably want 51% of ownership share in case something happens. They can take control of the property. So it's an option out there. I think it's great for small properties. Agency debt, their terms are so competitive right now. It's insane. It seems like they get more competitive the longer that we're not trading or not doing a lot of transactions. So agency debt for several years has, they've offered interest only periods. They've I think they've even gone down to like 1.18 DSCR for some of their stuff. The biggest hurdle to using agency for the longest time has been their 90 for 90 requirement, which means 90% occupancy for 90 days, right? That's basically to show that you have a stabilized asset. I've heard some instances where they've done 85 for 1. Right? Just show that you can get relatively decent occupancy for 1 day, and we'll give you an agency product. But the and of course it's fixed rate, right? You're not buying a variable rate thing and adding a acute interest rate cap on it or anything like that. So people that have been investing for multiple cycles, they like predictable cash flow, and the agency debt is going to give you the best terms to do that. And it is non-recourse. So when you're talking about putting together bigger deals, the bank is not going to come after you. They're just going to take the asset. So.
Hey, Tommy, quick question. Sorry.
Sure.
For the agency debt, is there prepayment penalties typically?
Yes. Yeah. I appreciate that.
How are they set, especially given today's interest rate environment, right? If you expect rates to be a lot lower next
for sure.
year, nobody can tell, but
yeah. So there's prepayment penalties on every agency product that you're going to get. And so I was going to make a comment towards the end here, but marrying your debt product to your business plan is going to be critical, but also your time horizon, right? So if I know I want to hold something for 5 years because I think the economy will be in a good shape in 5 years, and I know I will not have any intention of selling, then 5 years is the terms that I need to get on that one. If I get a 10-year loan and I try to sell in year 5, I'm probably going to be looking at a 6 or 7 figure, prepayment penalty to the bank, depending on the size of the loan and the purchase price there. So it definitely eats away at it. But the other thing too is gets into my next point. is that if there's a long enough term left on it, these loans are assumable, between Fannie Mae, Freddie Mac products. So someone else can come in and, they'll fund the difference, right? But they can take over the debt on the asset. I think there's been a lot of loan assumptions towards the end of last year and the first half of this year, because that's really the only thing that made sense to justify the prices that people wanted. Mayuk, I'm sorry, I kind of rambled there a little bit, but does that help?
Yeah, for sure.
Cool. Right on. And as far as, loan assumptions, you need to have a certain amount of equity in the property and a certain amount of leverage for this to work. So there was one property that's in West Nashville, like 276 units in a prime location, and they had about 30% left on their loan based on the purchase price that they wanted. And I was just like, you want me to bring how much? You want me to bring how much to the closing table? It was just absurd. So there needs to be a reasonable amount of leverage in order for this to be a realistic buying or selling tool. I just call it a case by case basis. And in most cases, if it's a smaller product, maybe you're okay with bringing more cash to the table and refinancing a little bit later. Some of these products are fixed, so it's more just a note on fixed debt in general. If anybody here ascribes to Ken McElroy, he will tell you that I've done deals at 7% interest rate. I've done deals at 6% interest rate, but back then the purchase prices reflected that. So now we're not quite there. Maybe we'll get there, maybe not. Maybe nobody's going to do transactions for 2 years until interest rates come back down. I got to think people will do transactions, but the business will be done. But there's something to be said for knowing where your cash is going, like knowing where your cash flow is. What are your commitments that you have? Whenever you have a variable rate product, that discussion gets to be a lot more stressful, right? You're reliant upon so many things that are outside of your control. And I think after what's happening, about 70% of the transactions that were made in 2021, which is, record-setting year in commercial real estate transactions, was made with variable rate debt. And so a lot of the folks here are probably in the know about, the looming crisis of commercial real estate, and that's because it's sitting on variable rate debt. Some of it has a interest rate cap, some of it doesn't. There's probably a couple of distressed transactions that are taking place behind the curtains that we don't know about. And maybe there's enough volume where they just have to come to market and we start seeing, price advantage. It's so telegraphed what's going on in the industry with regards to the distressed assets, that there's so much money waiting on the sidelines. I wonder if, me being in front of the curtain, how much we'll really see. With all that poo-pooing on variable rate debt out of the way, there's something to be said for, not locking in long-term fixed rate debt at the top of the debt cycle, where we're at. So that's why I just leave it as like, probably not terrible to do, but I know there's different people that have different stances on it. I'm a big fan of a surety, so I'm probably going to advocate for any fixed rate debt that we can get, because if it works with fixed rate debt today, it's gonna sure as hell work in 3 years if I wanted to refinance into to something a little bit lower and pull some cash out. So moving on to deal sourcing, right? If you're asking the questions of, hey, how can I, how do I find deals in this environment? I'll a couple of notes on this one. So if you're looking at marketed deals, something from Marcus Millichap or CBRE, Cushman & Wakefield, there's a running joke that the longer the OM, the worse the deal, right? The harder they're trying to sell you on something, the worse it is. My favorite is whenever they don't have any marketing material created and I just get a spreadsheet with rent roll and T12 and I don't have any of the fluff or, them trying to sell me something. It's just like, all right, this is their numbers. Let's plug it in. So I haven't, and you got to think about the position that brokers are into. I could probably take up the whole rest of the meetup talking about the position that they're in, but imagine you're an apartment owner and, broker comes to you and say, hey, I'd like to give you a, broker opinion of value, and say, okay, great. And 6 months go by and, 5 interest rate increases later. Hey, Mr. Broker, Mr. and Mrs. Broker, I'd like to take you up on taking my product to market if we can get that price. And so you got to think there's so many things that just don't make sense where it's just like, yeah, we'll try to get that number. And then you see these like these cost bases that just make zero sense, right? They're hoping for foreign money, they're hoping for 1031 money, they're hoping for unsophisticated buyers, they're hoping for someone to take advantage of and find the bigger fool out there in the world. And I mean that's kind of the reality of the industry that as it sits today. Good place to get them. True deals are kind of away from the marketed listings. The market is stuff you need to look at anyways, because you need to be making stock of what's transacting and how far off you are from asking. And is that percentage growing? Is it my fault? Is it the market's fault? Is it the broker's fault? But anyways, moving on to pocket listings. So this is a situation where a broker is going to come to you and say, hey, like I got this screaming good deal. Do you want it? And he's probably going to do that to, 3 other people, but those are going to be the best people in his network that he knows can take down a deal of this size and, align with what the people are trying to buy. But the broker is going to get to represent the buyer and the seller and the transaction, and their commission is going to be just fine. And they don't want to, farm it out and do, first round and best and final and, second round of best and final. And they don't want to go through all that stuff. They just want an easy transaction with good people. These are the needles in the haystack. These are what you got to find. If you don't have any brokers sending you pocket listings, find out who they're sending them to and be their friend, right? Add value to them, right? Be in their circle, underwrite deals for them, or, raise capital for them in their next deal, or JV something with them. Add value to the people that are getting access to the pocket listings. Otherwise you're going to a couple other options here to try to get a sense of the pipeline that's coming to market. So I like to proactively call brokers on like a 2 or 3 week rolling period and, just shoot the shit for a couple minutes. But just ask, hey, do you got anything coming to market? Are you working on anything? Are you trying to shake loose anything in any particular market? And so that's where you're trying to get a non-competitive first look. And so if you can say, hey, yeah, I know I got a partner that he already owns in this market, and we already know that this cost basis is incredible. Like, what would it take to take this down? Right? You're not competing with the rest of the United States in that environment. Those are the types of scenarios that you want to be in. Outside of that, it's hustlers. The hustlers, they're calling them mom and pops all day, every day. I feel bad for those mom and pops that are still out there. But those are the opportunities where you can try to score seller financing and say, hey, I'll give you your price if you give me my terms. And so, those are, if you were to ask me, how are you doing deals today? Those last 3 is what I'm focusing on. So I would be remiss if I didn't just cover some fundamental stuff here. I know it sounds like everyone's pretty well advanced, but if you were to ask me what I look for in market fundamentals, I'm going to tell you 2 things. I want job growth and I want population growth. And so there's other ancillary things to be mindful of, median income by tract. Right? Don't try to sell me on median income for the entire MSA when I'm only occupying a block, with my commercial real estate on there. So median income by tract is very telling to get your 135 mile radius demographic information. I like to see job diversity. There's a couple places that have just huge anchors in the market, and a lot of people kind of advertise it like it's a strength. So if you're looking in Warner Robins, Georgia, it's got the most civilian employed Air Force base in there, and you can say, oh my gosh, the job security and the pensions and the this, that, and the other. But what people don't realize is the housing allowance from the military base is basically dictating market rent. It's not even, organic renters competing against each other. It's just like people like the median income there versus like the monthly rent is insane. It's like one of the highest multipliers I've ever seen. And that's because the housing allowance is basically dictating the market there. You have the same issue with, let's take Tuscaloosa, Alabama, where there's, University of Alabama in place. Lenders are not going to like, when 70% of the tenant base is students. So be very mindful of this. This is, lender opinion, not just mine. not only mine, but be mindful of, look for some sort of diversity, not just a heavy anchor. If that heavy anchor were to leave, would, the ancillary businesses and services and providers, would they all leave too? If you're pay attention to Clarksville, Tennessee, I think some of y'all mentioned the Urusi. So the Urusis are in Murfreesboro. Clarksville is basically a military town north of Nashville. It's been super strong, but they had a deployment last year and everybody broke out. And so people like all these, smaller shops, they started reducing their rent instead of just being confident and that, hey, I'm bringing a good product to market for a good price. And so everyone dropped their rents right at the same time the base did a housing allowance assessment. And so now the military base's housing allowance actually decreased year over year. And that's going to affect a lot of, small investors that are in that market. So, we talked a lot about this before. So, be mindful of new construction and absorption. Nashville actually topped the chart in terms of percentage for new construction coming to market over the next 12 months. They didn't win in terms of volume, right? They're not bringing the most to market, but in terms of the most relative to its size, Nashville it's not absorption, but Nashville new construction is something like 30% of existing inventory. It's insane. That was a study by RealPage, and I don't have it in front of me, sorry, but look up the latest RealPage study on new construction relative to existing, and that's pretty eye opening. I honestly think within a couple of years, like it has the wherewithal to absorb that and be fine. But it's all Class A stuff, and there's all these REITs building on top of each other, and it gets really messy really quickly whenever you're in a desirable market like that.
Tommy, before you go on to the next slide, that was a great slide here. Something like medium income tract. What are the sources that you use for this information?
Sure, that should be mostly government census information. It's not been consistent because I think it's all kind of state organized. But if you were to look up median income by tract, Louisville, Kentucky, there should be some either a census website that comes up or like a Kentucky website that comes up for something like that. I haven't been able to find it consistently from the same source. I wish I could just say, hey, there's a data aggregator out there and you can just go here. But I would just say Google it for lack of being prepared to answer that question.
Great slide. Good information.
Sure. Thanks, Jerry. And then I think this is one of my last slides here. So I appreciate y'all listening to my monologue. But the last note is, around property management. I bring them up because they are a critical partner to, any asset manager or apartment operator that's making use of their investment. So proximity is super important. If you look at the overall architecture of a property management company, there's going to be their CEO, there's going to be, several, VPs, there's going to be a regional director, there's going to be, and then on, close to your property, right? You saw how many layers that was. And then on your property, there's, leasing agent, maintenance tech, maybe. And the person that's going to make or break your property is not going to be the CEO. It's not going to be the VP. It's not going to be the directors. It's going to be the person that's boots on the ground. And so if they don't know how to hire properly and hire superstars and attract superstars, then they're going to have a tough time. So the person closest to your property that should be the person that attracts you to using that property management company. You also, this is not an all-inclusive statement, right? You want to make sure that they've got accounting, they've got legal, they've handled assets of that before, they've done that business plan before, right? The list goes on and on, but just be mindful that the one closest to your property is probably going to dictate its performance more than anyone else. So, leasing, this has been, I had an interesting experience that I'll share. Some of the folks on this call know about it, but there's a property that we syndicated in Louisville, Kentucky last year. It was in one of the highest median income areas relative to its neighboring median income tracts. We know it is a C-class property and what we thought was fringing on a B-class neighborhood. But there was a couple of things that really just didn't aligned with its success, right? It wasn't near, public transportation. It wasn't, right on the major highway like all the other apartment complexes was. There's probably a couple micro takeaways from something like that, but we had a hard time getting the leasing up to where we wanted. And, what we found is that our top of the funnel was okay. We were actually scrambling. We're like, we need more top of the funnels. We need more total inquiries. We need to be on Facebook Marketplace in addition to, Zillow, Trulia, Lovely, Apartments.com, all these other places. We got to just blast it out there. Everyone needs to know about this, but it really wasn't the case. What we found was that the conversion sucked, right? We weren't converting top of funnel to into showings, into applications, into, move-in dates, into deposits. And so, be mindful that responsiveness is everything. If you get a call at 8 a.m. and you have to wait till your lunch break to call back, like that's probably too late. All right. There's probably, 10 people that picked their phone up on the first call or the first ring. So, follow-up is very critical. Being responsive is very critical. And so just having that be top of mind for a lot of the operations for your property manager and setting that expectation with them is going to be critical, especially as we've been, very mindful of I'm going to go back, as we've been very mindful of the headwinds around vacancy, right? I'm hypersensitive to that stuff. And so if we've had no showing for 4 weeks, I'm going to flip out. So that sort of stuff translates. So, work orders is very critical, right? Happy tenants pay. That's kind of the reality of the situation. I didn't get in this business to be a slumlord either. So just making sure you're handling the work orders in a timely manner. Some of this has to do with the property manager paying in a timely manner if they're going to try to attract some of the vendors they want. And so be mindful there. This is probably one of the best tips I can give you. It's not really apparent to most apartment operators when they get into the business, but the more that you can, the good thing about real estate is it's a people business. The bad thing about real estate is it's a people business. But the quicker you can build a community within an asset after takeover, because people are going to see the new signs, the new management signs, and they're going to roll their eyes and say, "Oh God," or got new management. I don't, whatever. I'm gonna, people see a new sign and move out, right? You go from 95% occupancy to 80% occupancy just because you put up a sign that says new management. So build a community, bring in the right people, have a zero tolerance attitude for the folks that are just, on the fringe or they're just bad actors, because it doesn't take long for a tenant that's seeing another tenant do the wrong thing and just say, I can do the wrong thing too, because I just witnessed it. Monkey see, monkey do, and apples rot the whole bunch there. So we do community events, we do tenant surveys, we give them, some platform to voice themselves, voice their concerns outside of just the work orders on the portal. This will probably do some sort of holiday competition, like a Halloween, dress up your door competition, something like that. We did a giveaway based on the surveys. We've been doing newsletters as well. And some of these are new for us, but that was, as soon as we started doing this, we started getting incredible feedback. It sounds weird to say, but one of the points of feedback we got from the last holiday event that we hosted was, it's been a lot quieter since y'all have taken over. And, it took a while for something like that to sink in, right? But if we're buying C-class product in C-class neighborhoods, and that's a huge compliment to the ownership group, I think. So getting that feedback is critical. And, in terms of getting those bad actors out there, act urgently. Don't think, I got plenty of time, or I need to extend plenty of time for these non-paying tenants. Just a little story about Atlanta, Georgia. So if you're anywhere on like the east side and the south side of Atlanta is DeKalb County. The west side and the south side is Fulton County. If you're in DeKalb County, the eviction date, it takes about 6 to 12 months to process. Right. So the judge would say, it looks like you've got overdue rent. You definitely need to pay that. Next date available 6 to 12 months from now. And you just non-enforceable, until then. Maybe you can do some scare tactics to try to get it out. But, there's markets in the US where a tenant could live for free the entire term of their lease. And so, act urgently, try to avoid those markets, or at least, take a calculated risk in those markets if you want to be there. But act urgently, act swiftly, don't break the law, follow whatever local legislation says to do, but don't dally. So I'll pause here. I inserted a pregnant pause for questions and dialogue.
Hey, Tommy. Question on Nashville area. I don't know if you said it, if you're invested there right now or if you're just based there, but if you are you concerned about all the construction that's going on there? And does that have you, maybe, is that why you're looking elsewhere into some of these other markets?
Yeah, I would definitely be concerned if I was, a developer. That the secret's been out. I think it was Urban Land Development Institute. They rated Nashville the highest, I guess. I don't know. They said their land was the most valuable, right? They rated Nashville, number one in their land value. And then developers just flocked, man. It was crazy. So we've been having new construction like crazy. REITs have been building on top of each other, self-storage, as well as apartments. And for me, it's like people are pushing REITs from behind without being so mindful of the fundamentals, because REITs can still show returns because they verticalized every aspect of real estate, and they can still make distributions and the business plan not be fundamentally sound. But I'm concerned in Davidson County. So Nashville is Davidson County, but I'm buying one county outside of Davidson. And part of that's because, taxes and how it's run, and they got their own issues with, short-term rentals and all this event space and stuff kind of crowding it. So I'm looking at one county outside of Nashville. Nashville's a fine place to be for sure. But I find that one county outside of Nashville, in just about every single direction, except immediately north, you're going to have cities that are poised for growth. You're going to have jobs that are coming to those places, and you're probably going to do fine there.
Yeah, thanks.
For sure. I like the Nashville questions. No one ever comes at me with those. I could talk all day.
Well, it's funny that one of my first, I think it was 2019, that I did go to Nashville, and I was just amazed about cranes everywhere, and that's I went in there kind of first thinking real estate, and when I got back home, I kind of did some studying of the map, and I did come up, actually, ironically, with Murfreesboro, which was kind of interesting because, those who know, then that's, I think, like within the next couple of months, actually, Jason Irusi actually relocated down there, and they had a property down there. But it just made sense because it was right down there. There was a university, there's an airport. It just, looked at it. So the growth. But yeah, I still to this day haven't seen so many cranes in the sky as I did in Nashville that day.
For sure. It's a tiny town, all things considered, right? If you look at I grew up in Middle Georgia and graduated from Georgia Tech, so I can't help but compare Nashville to Atlanta. Atlanta's like 5 Nashvilles. And so it's still crazy to think of just like how much they're building and, the runway for the city. So I don't know what to expect of what it's going to look like, but there doesn't seem to be many detractors for it just yet.
So I'm going to jump in with a couple of questions from the chat. First one comes from Mike. Tommy, there's been fantastic information with rent projections remaining at or near flat for year 1 to 2 for today's business planning. What creative options for increasing operating income in BC classes have you found to be successful? You mentioned community building. How about, Wi-Fi or wrap building, et cetera, bike share?
Sure. Yeah, I love the question. And it seems like people get more creative every day, especially with technology that's kind of been entering the space over the past 5 years. So obviously in terms of increasing, business operations is NOI, right? And so there's things you can do on the income, there's things you can do on the expenses. On the expenses, we try to pass as much of that through to the tenant as possible. And so if you've got an opportunity to individually meter water, that's a godsend, right? That's just home run opportunity. It's really hard to find. You're usually, trying to get 70% and you're just happy about it as far as water goes. Electricity should be individually metered. If you can resell the cable package, right? That's another opportunity for you to score maybe, $10-15 a month, but we all know what that does for the valuation of the property. If you can show that on your P&L, you could also repurpose it. And some of this is dependent on, your tenant base, right? So we have, property in Louisville. I don't think we're quite ready to resell internet, right? We're just trying to get people that can, pay on time. And so trying to, do all these one-ups like trash valet and, things like that on that sort of tenant base. I don't think it's mature enough for that yet. So just be mindful that some of these adders are probably best towards the end of your business plan, more closer to stabilization, where you've got the right people in your community that you want in there, and you're just trying to enhance their quality of life. And I think some of that requires a survey, right? Hello, folks, we're thinking about doing this. I think it could ease your life here, here, and here, here. Are you open to it? And so really pressing them for what they want for some of that type of stuff. So I'm not going to sell trash valet to Class C tenants. I don't think, garden style apartments. I just don't think it's not an easy sell. I think that a lot of these, I won't say it's a value add, but poop rents, right? Where you can, for every animal that's in the complex, you do a DNA swab. And so if there's ever a dropping in the complex that's unaccounted for, right, you give a fine to the tenant. Can't do that in C class. That's best for like Class A, Class B type stuff. But I do like that. I'm looking at your chat, Mike. I do like the idea of bike share. Community Wi-Fi should definitely be an adder on as well. I think hotels do that to us. So why shouldn't living communities? There was one other thing. Something more advanced, but I think the rent needs to be at a certain threshold and the tenant base needs to be at a certain threshold. But you can replace security deposits with security deposit insurance. And depending on your tenant base, you can also charge a move-in fee. So you're basically swapping out your security deposit for a move-in fee plus insurance, right? So recall that security deposit is not something I can show on my P&L. Right. It's in this deposit mechanism. It does not hit my P&L, does not hit my books. Right. But if I show, $100 to $300 for a move-in fee, to kind of show as positive income. Again, I don't have to tell you what that does to evaluation of commercial property. So, things to be mindful of. I think the challenge is knowing what's appropriate for the tenant base. Some of that has to do with amenities. There's going to be plenty of tangible things that you want to do to create community that you're not going to get an ROI for. So it's a good question to ask of what are the things that I can provide and, get income for.
Awesome. All right. Next question's up from Mark. As transaction volume has taken a leg down first half of 23 and deals are a bit harder to make pencil nowadays, how are you using your time outside of underwriting deals and making offers?
For sure. For me, it's digging deeper into the business. I operate on 90-day goals, a 12-week work year. If any of y'all subscribe to that, traction, there's a lot of overlay and that type of stuff. And so after the first quarter of this year, I quickly realized that, after we had 3 deals fall apart, I quickly realized that the thing that I was missing in my activity, right? I was talking to so many brokers a week. I was underwriting so many deals a week. I was, talking to so many investors and potential passive investors, right? But the part I wasn't doing was, networking with my peers, really building deeper relationships with folks that are, in my market, that are getting access to those pocket listings, or creating deals where no one else can find them. Outside of that, if you were to ask me how has our buy box changed, my tolerance for risk has drastically reduced. Where back when 0% interest rates were a thing, I would have bought in tertiary, maybe even rural markets. We don't go outside of secondary now, and so we have minimum population thresholds. We're very in tune with what the local legislation has appetite for, right? So there's plenty, especially in Tennessee. There's plenty of population 10,000 towns that want to stay population 10,000 towns. There is a deal I passed on a little bit ago where it was $40,000 a door for $600 in place rents. I could probably go to 800. That's almost the 2% rule cost basis for any all that follow that, which is just incredible, right? But it was population 13,000, and the population growth was under the national average. You're thinking in Tennessee, how could that be possible? But it within Tennessee, it was like the nursery capital of the state. And so they cherished all the land that they had. They had no appetite for any new businesses coming to their place. I think the newest thing that they had built was a Zaxby's sometime in like downtown. And that was like and everything else just like so old. So you got to be mindful of, what does the city want? Right. Do they have appetite for growth? And we're starting to see a couple more legislators loosen up on that here in Middle Tennessee and between Middle Tennessee and East Tennessee. But I'm getting pickier. It sounds weirder to say, but I've turned away so many deals that I probably would have said yes to. But with that, I need to look at other markets. So I'm selectively, getting educated, doing diligence on other operators that are in other markets. I'm even looking in Columbus, Ohio, places where I'm just like, the Rust Belt, like who the hell wants to be in the Rust Belt? But just know that, I'm also not wanting to go to a place that's like Dallas, where literally the whole world has eyes on something like that. So trying to be mindful, pick my battles, but also I'm looking at smaller properties. So where I wasn't considering JVs a year ago, I am considering JVs, joint ventures, on super small stuff, just for the sake of getting traction and experience. And there tends to be yield in the smaller stuff than something that's 200 units. And you have to have a very complicated capital stack to take something like that down. But I rambled a bit, Mark. Does that help?
Absolutely. Thanks.
All right. I'll add one quickly. You mentioned, a couple of deals that kind of came apart in the last year or so. Similar situation I had, I guess in the last 7-8 months, 2 deals that we were close on that came through. What are some of the learning experiences that you gained from those experiences on those deals?
Man, anything. Well, most of the stuff that we were looking at was larger, and alignment of the team was really just that was the reason that everything fell through. Sellers just non-motivated doesn't begin to describe them. Like, why are you here? So just knowing, whatever market or whatever asset you're looking at, have a plan A, B, C, D for every role that's included in there. And so if we were looking at a 70 unit complex and north of Atlanta, and we needed a key principal to sign on the loan for experience or net worth, be prepared to, fill in some of those slots with, plan B, plan C, make sure that your plan A likes plan C and that they know each other and that they're okay with working together. Sometimes that falls out where your backup doesn't like your primary. It just doesn't work out. So, it goes back to my slide about, sometimes this business is really just herding cats, and trying to align on team members there. But that's where, digging your well before you need it is so critical. Build relationships with folks that you don't know you'll need relationships with, is going to be valuable.